Uncle Hank here. Hey, do you know that there's a way to make money in the stock market even when it's going down? Well, let me show you how to do that in this next video. It's called short selling a stock. Okay, so today we're going to talk about short selling to make money when the stocks drop. So this is an excellent way to make money in the stock market at all times. Short selling a stock is where the investor expects the stock to actually go down and not up. So this is a situation that occurs oftentimes in the market. The process of shorting a stock is that the investor borrows stock from the broker and immediately sells it back to the market. This action causes a margin relationship to be established between the investor and the broker that is going to hold and manage this trade. The profit for this type of trade is based on selling it high initially and then buying it back at some future date at a lower price. So let me give you an example of a successful short sale. This is where the investor makes money. On January 1st, the person borrows the stock and resells it at $100. And then they hold this position for 1 month. And then they notice that the stock price has dropped to $10 from $100. And so this is an excellent time to exit the trade and take your money. So they buy the stock at $10 from the market and they return the shares to the broker. And this closes out the trade. The net proceeds from this trade is $185 based on that initial $100 investment. So the net proceeds include $85 of profit in this example on a $100 trade. So they make 85%. The proceeds include a couple things. There's a fee that the broker charges called margin interest, as well as some additional fees that the broker can charge. And so I put in the $10 fee for the broker as well as the $5 fees. So that's how I got to $185 net proceeds. Now I'm going to show you another example where this trade went really wrong. It was a bad trade. On January 1st, the same exercise is taken. So they borrow the stock and resell it at $100. But then the unexpected happens and the stock actually goes up, it doubles. And the investor is saying, let me cut my losses and get out of this trade. So they buy the stock at $200 and return the shares to the broker. And this closes the trade. At which time the settlement is the net proceeds of this trade. So in this case, the investor has lost all of their money and has to also pay the broker an additional $5. So in this example, they lose their initial $100, and then they also have to pay the broker some fees. So this is an example where when the price goes up on a short sale, the investor could lose all of their money. So let me explain some of the risks and fees associated with shorting a stock. The first example is there is a margin account is required when you enter a short sale transaction. And this relationship is done with the broker. So they hold the collateral, which is your initial money, as collateral. And while this trade is open, they will charge a margin interest. And this margin interest is based on the risk of the trade. And so if you are shorting a very risky stock, such as a penny stock, or one that is not very liquid, or it otherwise has a lot of risk profiles. The broker will assess the risk of this stock and charge you interest accordingly. Then there is another risk, which is called a margin call risk. This is where the position has gone against you and the trade is losing money. And so the broker will require that you put additional money into this account to secure it. And that is called a margin call. The other risk is what's called a short squeeze. And this occurs when a lot of short sellers are have this position of a stock, and all of a sudden they all want to get out, and a lot of them want to get out, and so they have to go out and buy this stock. And when a lot of people are buying stocks, the price of the stock goes up, and this creates a short-term increase or spike in the price. And this is a situation that makes your trade a lot less profitable. So in summary, there's a couple of different things with short selling. It is a way to hedge your portfolio. And so you can have a basket of trades. Some of them you're holding and hoping that they go up in value. And then you have these other stocks that you are shorting so that when the stock market goes down, the short positions are profitable. And so your overall portfolio is doing better whether the stock market is up or down. The other idea is that stocks actually fall faster than they rise. And so a short position is particularly profitable because short term moves in the market are rapid and large on some stocks downward. And this type of transaction is meant for short term speculation. And so you shouldn't have a short position for a long time. You have to have your target of how much money you want to make and then exit that position when you make it. And don't think of it as hold, buy and hold type of mentality of having this position for a long term because of the margin interest. And the other idea is that this type of trade, there is no limit to the money you can lose. You can lose more money than you actually put in to this trade. And so this could open you up to having a large loss of money. Those are the points. Hope this has been helpful to you. If you have found value, please like and share this video and subscribe to my channel as well. It's Uncle Hank _03.